So a lot of people are talking about STOs and securitized tokens in general being super interesting, and I think maybe. Almost everyone, I think, missed the big lesson from the 2017 ICO boom. The big lesson comes from this question: why on earth were entrepreneurs willing to issue a completely unregulated asset, one that many of them didn't even really understand, that was an existential regulatory risk to their company? And on the other side, why were households and retail investors willing to buy it? I think what that really is demonstrating is that a bunch of really well-intentioned regulation to protect investors has made it functionally impossible for any kind of households to access high-value deals, especially at a time when interest rates are super low, where equity valuations are already insanely high. Where do you go to buy yield, particularly as a retail investor? As an institution maybe, or as a massive accredited investor, you can go to private markets where there's higher yield. And the private markets can move down the risk chain by buying earlier and earlier stage startups where they're even doing larger seed rounds now. But for the entrepreneur now, if it's going to be prohibitively expensive for them to actually be able to access public markets, by now is basically there is a functional cartel of accounting firms, law firms, and investment banks that protects access to public markets because of all the regulatory burden. And then even if you do get through all those, you hire the white shoe law firm, you hire the big four accounting firm, you get underwritten, then once you do it, you have to be a large enough company that you can afford to fulfill all of the reporting obligations ongoing into the future. For an early stage entrepreneur, there is no real access to public markets there. So early stage entrepreneurs are instead forced to private markets. Problems with private markets, they're very relationship driven, they're extremely inefficient because there's so few people involved in them. And because you're selling big chunks of your company at a time, you're selling additional upside because you're always selling preferred stock, and you're giving up a ton of control over your future development. On the retail side, these people were willing to buy assets they had no understanding of because they don't have access to those high value deals that are happening now primarily in private markets, whether it be through PE, VC, whatever. The real thing that was demonstrated there is that there's too much of a barrier for public markets to access early stage entrepreneurs. That's the real lesson of the 2017 massive demand for ICOs. Now, how does that apply to STOs that people are getting really excited about right now? Are STOs a thing that can potentially make a new way around that? And the answer to that is it's really to be seen. It really depends on how the SEC approaches it. The SEC can approach it by saying that tokenized securities are securities, but in some of these venues, we're going to allow a little bit of a sandbox from experimentation, or they can be pretty rigid about it, in which case it's going to make no difference doing that versus paper equities. There's nothing particularly interesting about being able to settle on a blockchain versus settling in a state registrar, something you can already do and all you're doing is replacing a settlement layer. But in the world where the SEC maybe allows for this tokenized securities exchange that organizes Reg D or Reg A sales of tokenized securities, and then after a certain period of time, those things become liquidly tradable unless you incur the reporting obligations that come with having too many people on your cap table. Now, there's already a solution potentially in place for that problem, which is that companies like E-Trade that sell, there's some particular word for it, it might be like beneficiary ownership or whatever, but aren't technically on the cap table. If you look at Facebook, there's some insanely low, like only a few thousand people who are technically on the cap table. I'm not sure exactly what the number is, because if you hold the exposure to something like E-Trade, you don't necessarily count as being on the cap table, you just have exposure to that equity's value. So whatever the infrastructure is allowing for that thing, maybe you could have an exchange where the exchange is the only person technically on the cap table, but the exposure to the equity is liquidly accessible by retail traders. Now, that is so obviously a structure like that that's kind of using a bunch of half exceptions in order to create something that can be liquidly traded but isn't technically having a ton of people on the cap table. So obviously against the spirit of the law, may be okay according to the letter of the law, but what's the SEC going to do with that? Are they going to actually enforce it, or are they going to use something like that, if that infrastructure gets built, as an opportunity to experiment with a reasonably small portion of the population that isn't going to screw over a huge portion of their, supposed constituents? And so basically, whether or not there's anything interesting happening with access to capital through STOs has entirely to do with how rigid the SEC decides to be, about whether these can be treated a little bit differently and a little more softly than securities. Thank you for watching. If you have any questions left, let us know. We'll make more videos to explain anything, and make sure to sign up for our free beta at tigertrading.com.